Most people think there's only two ways to purchase a car. You either pay cash or you finance. There's actually a third option, and that one makes all the difference. I'm Kyle, and I believe everyone should be living a very intentional life. And I'm simply a guy that helps build financial systems around banking, tough money habits, and generational wealth. So in today's video, I want to break down this third option on how we can be way more effective and efficient with making large purchases in our life, like owning vehicles. Now, in order to understand this, we have to understand who are the players in the money game, and more importantly, who do we want to be? You see, we've all been the saver at one point in our life. We've always used a banker, and we've all been the borrower at another point in our life. Now, watch how interesting this flow of money is. The savers save money with the bankers lend money to the borrowers pay back the bankers at a high interest rate, and the bankers pay back the savers at a low interest rate. Now, whether you're a business owner, an investor, an employee, a self-employed individual, we all have to use the bankers in our life. And so the question I would ask is, well, what if we also became the banker? You see, if you own that middle section, which is a control conversation, now you create what's called this closed economy. And it's one of the reasons why getting a copy of this book right here, Becoming Your Own Banker by Nelson Nash, is so vital for getting the right financial systems and paradigms in place. And if you will understand what's in this book, it'll change the way that you look at money forever. And it'll make you realize there's a third option to make large purchases in your life that we were just never thinking about, because we're not thinking like bankers, we're thinking like consumers, business owners, or investors. So let's continue on. Let's take a look at what I call the annual pattern of spending. Now, most Americans, with the income they bring in, they're going to spend about 20% of their take-home pay on automobiles, 30% on mortgages, 45% on lifestyle and living. That's everything else. And the average American is saving about 5% of their income. Now, something that didn't sit right with me when I was looking into typical financial planning is typical financial planners would look at this and say, Kyle, take the 5% you're saving, which you're doing great, by the way, and go put that in an environment that has more risk so you can accelerate it and get a higher rate of return. Now, I'm not going to say that's a bad thing, but when I was kind of taking a step back and looking at this system here, I was kind of saying, doesn't it make a whole lot more sense to be more, to own more and control more of the flow of money that's leaving our hands every single month? That's the 95% that's just flowing in, flowing right out. And so this has nothing to do with investing or investments. This has everything to do with controlling the flow of money, which is what banks are so good at. So what we're talking about in today's video will require a change of thinking. So we'll break this down even further. The two options that most of us were taught to look at when it comes to making large purchases like vehicles, you are either going to pay cash or you're going to finance it. We also call that the saver or the borrower. And so when you are asking yourself, what are the benefits of paying cash? Now, if I'm speaking anywhere across the country in a room of 30 to 50 people, I'll try to divide the room if the room is the right size, and I want to get two camps going. Where are my pay cash people? Where are my finance people? And majority of the time, the room is split very 50-50, like equally. And the pay cash people say the benefits of paying cash is I don't owe anyone, there's no interest payments, I own the vehicle, a lot of times I can get a discount, peace of mind, I feel more disciplined. There's a lot of benefits to paying cash. Now, on the financing camp, a lot of time that's where I get my business owners and investors. They see their money as having a cost. And so if I can earn a higher rate of return investing, I don't want to give up my cash position or my liquidity to go spend money on a vehicle that maybe has a 5, 6, 7% interest rate. So if I could make more than that, why would I give up my money? Both of them are right. And so you have to build your financial frameworks and systems around what are you trying to accomplish and how do you use money game to your unfair advantage. Next question is a little bit harder to articulate, especially for the cash side, which is what are the costs? I think it's easy to say what are the costs of financing because that comes with an interest payment attached to it, and we see that money leaving every single month. Now, what are the costs of paying cash? That one's more difficult to articulate and calculate because when you give up your cash, you're also giving up any interest you could have earned on that cash, not for 3 years, not for 5 years, but for your whole life. And this is a problem most people don't realize they have. And so that's harder to calculate is what is it costing you over your lifetime to make that decision. And so I want to ask you a question. After all the automobile purchases you've made up until this point in your life, think about how many cars you've owned and driven. 3, 8, 11, whatever that number is. How much money do you still have in your control, whether you paid cash or financed? Now, you came to that conclusion fairly quickly, and it's a big fat zero. And how do I know that? Is because my answer used to be zero as well, because I only was taught that there were these two options. You see, the person that pays cash is going to delay that purchase while they save up. And as soon as you save up enough money, you're going to drain that account down to zero. You're going to buy your car, and you're going to start saving up as you start driving it again. Now, on contrast that to the borrower, they're going to get the car immediately, go into some debt, make payments as they're driving it, and as soon as the payments are, the car is paid off, they're going to trade it in, human behavior kicks in, we go finance another one, and away we go. And we do this over the course of our life, and look at both the saver and the borrower both end up with $0 in their control because we're thinking like consumers. We're not thinking like bankers and controlling this flow of money. So how do we solve this? And by the way, this really frustrated me when I learned this over a decade ago because I came from a pay cash family. That's the way I was taught. That was our financial system and model. And I thought I was being the most efficient that I could have been. And so here's the reality. The average American is going to drive about 13 vehicles in their lifetime, and they're going to spend roughly $400,000 doing that, and they're going to end up with $0. Now, these are the averages. So you might be higher than this, you might be lower than this, but this is kind of how it averages out. Now, whether you pay cash or finance, the input is the same. The output is drastically different. It's zero. So you're not keeping any control of the money flow to your life. Now, I'm going to show you the third option, which requires a couple different changes. Change number one is you have to change the environment where you save and hold your money. And then the second change you have to make is you've got to change the way you think. We're typically taught to think like consumers, business owners, or investors. We've got to think more like a banker and our money having a cost and controlling that flow of money in our life. If you'll do that, you can spend the same amount of money and end up with well over $1 million in your control. And I'm going to prove that to you with some math. Now, let's jump over to the uncommon benefits of whole life insurance. I love whole life insurance. I started buying these policies well over a decade ago. Everyone told me I was crazy, and everyone was completely wrong about classifying this type of asset. Life insurance is the toughest foundational asset you can own because you will not find any other singular asset with those 8 benefits built into one place, and especially not with the guarantees. And so some of the benefits I'm going to focus on for this next example on how to make purchases using your life insurance policy are number one, the constant compounding. So when you save in a whole life policy, you permanently keep those dollars working for you forever. Very different than how most people are treating their money, where they're in a constant state of transferring money away. We're going to talk about the competitive yield. You have a much higher competitive yield long term on an insurance policy than you do a typical checking or savings account. We're going to talk about the income tax-free transfer of wealth, which is the death benefit, and the flexible loan provision. So the policy, as you build up what's called cash value, allows you to borrow against it. You don't borrow from your policy, you borrow against it. So your full cash value will be compounding, and you can use the insurance company's money to acquire assets or make purchases, in this case, with a vehicle. So having an understanding of what this asset is and how powerful those benefits are give you some very unique advantages in the money game. So I'm going to pull up a software. This is called Truth Concept software. And I think every single life insurance agent should be using this as part of their wealth plan. Okay, so we've got our Truth Concepts calculator pulled up right here. And the math behind financial frameworks is incredibly important, okay? So we need to understand how a financial system and model, but then we need the right mathematics behind it to make sure that the decisions we're making are actually playing out the way we thought they would. So we are going to be looking at the top left of the screen up here over a 50-year time frame. So I don't want to hear you watching this video saying, I don't have that much time left. Compounding does not care when you start. It rewards those who never quit. And I absolutely believe every American can win the money game or increase their financial situation drastically in a 5, 10, or 15-year time frame just based off having better financial models and guides in their world. And you have to be able to work at this too. So don't think anything that we're showing is just magical. So as we're going through this, you might be further into your life journey than others. That's okay. There's always time for us to get better. So we're going to be looking at someone that has $10,000 a year just flowing through their life. And this is typically going to sit in some type of checking or savings account earning 0% interest. Most checking accounts that we use pay us little to no interest. And then we take money from those accounts and we send it off to a financial institution for like vehicle payment, which is what we're going to be looking at. Okay. So $10,000 a year for 50 years, that's $500,000 into this system that we're now going to use to buy vehicles. So let's look at the most popular way to purchase a vehicle, which is to go out and actually finance it with a bank. So we're going to be looking at buying a $30,000 vehicle in the 4th year of this plan. And we are going to just be looking at one loan right now, and we're going to pay this loan back over 5 years, okay? So the vehicle right here cost us $30,000. But with the principal and interest, now we're looking at this red column, the $30,000 vehicle down here at the bottom cost us $36,584. So that's the principal and interest. Okay, that's how it looks with one vehicle. Now let's look at buying 9 vehicles over this 50-year time frame. Okay, so a lot of numbers on the screen. 9 vehicles, $270,000 of principal. With the interest at the end of this too, it's not just $270,000, it's $329,000. So almost $60,000 of interest was attached to the vehicle there. So we want to separate some of these things. We want to see, what did we put in? What is our output? So we're going to take $500,000 and we're going to minus the $329,252. That's the principal and interest, that column in the middle in red, which gives us $170,748. So if I was utilizing this method, I've got money sitting in a checking account, that's the environment, and then I'm using it to send money out to pay the financial institution to borrow. I borrowed money and I'm paying it back. What I would have left over is $170,748. That would be my cash position. Now, if I'm big on stewardship, legacy, generational wealth, which I am, that means if my time was up, I would also leave $170,748 as part of my legacy. That could go to my kids, our trust, a nonprofit that I love and support. That's money I want to give at the end, okay? Now, what do? We say, well, I don't want to pay anyone $60,000 of interest, right? So we say we're not going to do the bank finance method. Instead, I'm going to do what my parents taught me, and we're just going to go pay cash. So I'm going to save the same $10,000 sitting in some checking account, and then every time I need to go make a vehicle, I'm just going to withdraw $30,000. So you see the account value over here. It drops by $30,000 the same time we're still saving up, because we take money out of that environment, and then we just go we go buy the car, and now there's no more red columns, no more interest being charged. It's purely just principal. So 9 vehicles at $30,000, fairly simple math, it's $270,000. So if we look at the input, we put the same amount of money into this pay cash program, $500,000, minus the $270,000 would leave us $230,000 in our cash position by the end of this time frame. Now, that would also be your legacy is $230,000. So pure math to math, it should not be earth-shattering news for anyone watching this video that the pay cash method, you are ahead of the checking and bank loan method because we're not paying interest payments, right? So we're about $60,000 ahead of the person who's financing at the end of this time frame. Now, both of those people are not creating any type of sustainable wealth utilizing this, and they have to do this in their world. So we're going to change 2 things now. We're going to change, number 1, where we're going to save our money to make these transactions, and then we're going to treat our money the same way we were willing to treat a bank's money, and in that case, it was paying them 7% interest on that loan, okay? So we're actually going to use option 1 and option 2 kind of blended together for this infinite banking concept. And so we're going to pull up a whole life insurance policy, and when we pull up the policy, we're going to pull in the internal rate of return on an insurance product as well. Now, most good whole life insurance you're buying with a strong mutually owned carrier will have like a 3 to 4% internal rate of return over a very long period of time. So when you are buying a life insurance policy, you are absolutely going to be behind the first two options in the first several years of this process. But as your policy grows and continues to compound, you're going to far exceed both of those options over time. So you have to know that going in. If you cannot think more than 3 years in the future, this is definitely not the strategy for you. Now, the other thing that's unique about this, so number one, we're getting a higher long-term yield on our savings. The other one is when we want to go buy this vehicle, we are not going to borrow from the policy. We're going to borrow against it. Okay, so we are going to take a policy loan against the cash value, which is why you never see this account go down over time. It's uninterrupted, continually compounding, okay? So you might delay some of these purchases utilizing this concept, but the long term, you're going to far out exceed. Now, the other part is if you are willing to pay a bank 7% interest, when you use the insurance carrier's money, they are going to charge you an interest rate. In this case, it's around 5%. So if we were willing to pay a bank 7 and we're going to borrow against the policy at 5, I would pay the same amount I was paying to that bank just to an institution I own and control now. So part of that money goes to the insurance company. The additional 2% is what's going into this as additional premium for the policy. And that is how banks work. Banks lend out money with an expectation that more money comes back to them. This is a banker's mentality. Now, this might take you a few times to go through this video and read this book until this concept clicks. And then once it does, you will never look at money the same way ever again. So at the end of this time frame, the same exact input as the previous two methods, but look at the output at the end of this. We now have $1,365,722. That is our cash position. That is 6 times better than the next best option in this. And so not only is our cash position so amazing, but remember, we are using a whole life insurance policy as our foundational asset, which means it comes with death benefit. So this specific example, the individual would have had about $1.7 million that would be income tax free to their heirs, their trusts, beneficiaries, nonprofit, wherever they wanted to also give as part of their legacy. So not only is our cash position substantially better at the end of this time frame, but the legacy that we can give now to the next generation is substantially higher as well. And so this is definitely a long-term strategy, but you want to be thinking about how can we be more efficient utilizing the infinite banking concept, using a whole life policy as part of our wealth building strategy. And this is exactly why you would want to do that. So in order to wrap up this video, let's go back to these 8 benefits on the screen. The reason whole life insurance is so tough is because there's no other singular asset that has these 8 benefits. And one of the greatest benefits is you get this constant compounding of your savings. See, if you just use a typical checking or banking account, you're always in a constant permanent wealth transfer away. Whether you're a saver or a borrower, someone else is ending up with all the control of your money. Whereas if you utilize a whole life insurance contract, every dollar you save in a form of premium, you capture and harness and earn interest on for the rest of your life. And when you are ready to use the money, you take a policy loan, so you borrow against it, and as you pay that loan back, thinking like a banker, your cash position is at a new high every single time. Now, the first several years of starting this process, you are going to be behind, and you're going to feel behind the people that are paying cash or just borrowing. And this is why you have to take a long-term approach to this. But if you can give that some time and you get these policies out 5 years, 10 years, you're going to start to see a separation from the rest of the people. So when I was buying these policies well over a decade ago, I had a lot of people telling me, you're crazy, you shouldn't be doing this. And now I look at them and they're in the same exact cash position for large purchases in their life. And I am creating massive wealth doing the exact same thing they're doing now. It's just I have a financial system that works way harder for me and my family. So when you're starting this journey, just know there's a ramp up period. But the reason you want to commit to this is the longer you take this out, the more compounding that this system will do for you. And this is exactly why you want to take the concept of becoming your own banker and make sure you pair it with our financial management system. This system is so flexible. You have to have the right discipline. So you want to make sure that you've got what we call really tough money management habits in order to be really successful with this concept. So as always, this is a leadership conversation. Stewardship is the path. So choose truth over trends, education over products, and people over profit.